The goal to get rich is to understand the algorithm. You have to be able to crack algorithms to understand the process of how a product works. Welcome back, everybody, to the Crypto Compass, your guide to everything crypto. When thinking of the algorithm of crypto, you have to think of all these different metrics that are coming out. We are going to deep dive into all of these metrics so that you can understand how to profit from them. A little side note before we continue, the NFL season is coming back and I'm super excited. And I got my gear on. Let's go, Cowboys. The first thing that we are going to discuss is market capitalization, or market cap. The market cap of a coin is very important to understand when you're going into the tokenomics. So the market cap is calculated by multiplying the price times the supply of a coin. If you look at the basic metrics, you will understand that the lower the supply, the higher the price could go up. And that's just because of the demand that will pick up, because less people will be able to get their hands on this asset. As the price moves up, the market cap will also go up. So it's very important to get into these low market cap coins soon and quickly before they pop up. Not all low market cap coins are good. You have to find the ones that are fundamentally strong and provide some kind of value in the space. A lot of these micro caps tend to consolidate, and some of them might even be rug pulls and completely go to zero. Then you have things like funding rates. Funding rates are exactly what the name suggests. They are funds that are paid to either long or short traders. There is the concept of perpetual futures contract, which means that you buy a contract for the future to suggest what the price of an asset will hit. So for example, for Bitcoin, if it's sitting at 25,000 and you bought a futures contract for 28,000, you're suggesting that the price is going to hit that amount. And you have long and short contracts. The long contracts think the price is going to go up, and the short contracts think the price is going to go down. So when we have an overflow of longs, those longs need to be funded, and they are funded to the short-term traders. And vice versa, when there's an overflow of shorts, those shorts fund the long-term traders. So there's the concept of negative funding. That's when the short-term traders are funding the long-term traders, and positive funding when the long-terms are funding the short-term traders. Understanding both of these concepts is very key, because when there's too many longs or too many shorts, that's usually an indicator that there's going to be a big move coming in the opposite direction. So if we have a lot of longs, we could see a short or the market dip. Or when we have a lot of shorts, we could see the market long and the market go up. Another metric is open interest. Open interest is the total amount of contracts that are being bought. So when you see a specific futures contract that is being bought more than others, you know that the volume is flowing in there, and that could be an indicator of where the market is going. So if we have a lot of longs being bought and the open interest is rising and the shorts open interest is falling, you know that maybe these smart investors or traders are trying to go long, so maybe the market might go up. But of course, you can take the contrarian approach to this as well and say if a lot of people are getting in longs, maybe you want to do the reverse and go short. The next metric is stable coin flows. So a stable coin is a coin that is pegged to $1. So that means the price never fluctuates too much higher or lower than $1. It may go up to $1.02 or 3 cents, or maybe down to 96.95 cents, but it'll never go much lower or much higher than that. A stable coin is meant to keep your money stable, as the name suggests. So that means if you want to throw all your money in there, your equity value is going to stay the same. You throw $1,000 in a stable coin like USDC or USDT, for example, that $1,000 will fluctuate very little compared to keeping that money in Bitcoin or Ethereum, where the market is constantly fluctuating at much higher volatility. And when we see stable coins coming in and out of exchanges or going into certain wallets or out of wallets, it's usually an indicator that people are trying to buy the dip or sell their money and get out. With the blockchain being so transparent, you can see exactly when people are going more into stables or when they're deploying more capital out of stables. And that's usually an indicator of where the market is going to go. And at that point, you can understand that when people are bringing money out of stables, they're trying to buy more assets and the market could go up. Or when they are trying to get more into stables, they are waiting for a dip in the market to buy the dip to deploy their capital. To add on to this, you have exchange flows. So that is the money that is going in and out of exchanges. So normally when you want to transfer money to an exchange is when you want to sell, because exchanges are the medium to sell directly going back to a bank. And the same goes for exchange outflows. So when big money is going off of exchanges, you know that that person has the mindset of sending that money off to let it build and grow more profit, and then eventually they'll send it back to an exchange to sell. We also have the fear and greed index that I covered in one of my other videos that I will point out right here. And this is basically an index showing when people are getting fearful and when they're getting greedy. And usually when they're fearful, that's when you want to buy. And when they're greedy, that's when you want to sell. And then you have indicators like the Bitcoin rainbow chart. And I would recommend that you take these indicators with a grain of salt and you don't just dive in and automatically trust everything these indicators are saying. Because a lot of these indicators can fall out of trends, or they can show you false trends that really don't align with the economic outlook and exactly where the market's headed based on many other factors. This rainbow chart shows exactly where Bitcoin bottoms and tops. It shows all the different levels based on a color scheme. And depending on what color we are in, that's a good indicator of when you should buy and sell. Looking at the market as a whole, we know that the market comes in cycles, just like everything else in life. So we have 4 years of a bear and 4 years of a bull. That's normally how it goes. But obviously that fluctuates depending on what the market outlook is, how the economy is moving, what restrictions are being placed, and many other factors. Bitcoin has a halvening every 4 years, and that halvening is usually followed by a bull market. And that bull market peaks in about 2 years, and after that we fall back into the bear. We've seen this consistently since the major bull market in 2013 up until now. And if this trend holds, then we are headed into a bull run next year. This is why I urge all of you to get into the market now. I want you to be able to position yourself for the maximum profit possible. And right now, you are still early. So if you have any questions, you can reach out to me and I can set you up in my coaching program. I can go over all the coins that I'm bullish on. I can tell you exactly where I would buy and sell, and go over many different indicators like technical and fundamental analysis, and we can deep dive into all of that. On top of that, I can get you into some airdrops that are completely risk-free. This money is free money coming from the crypto market. It's not your money to begin with. So if it goes to zero, it's not a big deal. Follow the link below to sign up for my coaching program now. I'm putting videos out like this very often. So please subscribe to the channel, hit that like button, and hit that bell button so you don't miss another one of my videos. I'll see you guys in the next video. Peace.